Hello everyone, we welcome you to the fifth episode of the Saransh series. Today's episode is basically a finale episode. Why do I say that? That's not the end of the Saransh series, but it would be the end of the discussions on the listing regulations. Today's episode, we are going to deal with the policy framework and disclosures in corporate governance under the listing regulations. This episode is going to touch upon two broad points. The first being policy framework. Under the policy framework, two things we are going to cover. First is for companies which have now become listed, they are required to make certain amendments in their existing policies which they already had under the Companies Act regime. The second thing under the policy framework that we are going to cover are the new policies that they are required to adopt after becoming a listed entity under the listing regulations. In the second part of the episode, we are going to deal with the corporate governance disclosures under the listing regulations. To start with corporate governance, of course, we are going to cover the quarterly corporate governance disclosures as well as the annual corporate governance disclosure, which goes as a part of the annual report. Now, before we start with the core content of today's discussion, let's be very clear on one part, that policy is not a piece of paper to contain reiteration of the provisions of law. It is a framework to actually help to actually come to the rescue or to the guidance when you practically implement it. So therefore it has to be customized, it has to be detailed, and it has to be a guidance to practically implement the provisions of law. So therefore, motherhood statements which generally form part of policies like as per the internal management's call or as per the internal management's decision or as per the internal procedures or SOPs, only stating these phrases in the policy will not help. If you are saying that there is an internal mechanism, if you are saying there is an SOP, then it has to be ensured that there is actually an internal mechanism, there is actually an internal framework which has been prepared very minutely, and that framework has to be read along with the policy. While not necessarily being reflected in the policy as far as the details of this internal mechanism is concerned, but surely this has to be read with the policy. Now starting with, I think Payal, you can now start with the existing policies which are already there with the unlisted companies, which requires an amendment.
Right. So as we discussed the existing policies that an unlisted public company would usually have, but due to changes in the systems, changes in the processes and the compliance framework, as the company becomes a listed company, it will also require to make certain changes in their existing policies. For example, let us start with the whistleblower policy. So unlisted public companies, basis certain thresholds, are required to have a whistleblower policy and a vigil mechanism in place. However, under the Companies Act, the coverage of the whistleblower mechanism is limited to the directors and employees of the company to report concerns with respect to the unethical practices of the company or any personnel thereof. Please note that any sort of grievance or any sort of complaints against the listed entity, apart from the unethical practices of the listed entity, are not covered under the whistleblower mechanism, and the listed company has separate grievance redressal mechanism for the same. Here we are talking about those complaints reporting of those instances where an unethical practice of the company is involved. Now, as a company becomes a listed company, considering the broader group of stakeholders involved, be it the vendors, the employees, workmen, other external stakeholders, lenders, etc., the listing regulations require listed companies to extend their whistleblower mechanism to all stakeholders. Therefore, any person who has a complaint with respect to the unethical practices of the company can use the whistleblower mechanism as a recourse to report their concerns and obtain necessary redressal for the same. Next, we talk about the nomination and remuneration policy of the company. This again is a policy that every unlisted public company is anyways required to prepare as per section 178 of the Companies Act. So what is the change when it becomes a listed company? For a listed company, again, the listed company is required to identify what all skills are required in the board of the company. Such skills matrix, along with the skills that are presently there in the board of the company with the relevant director of the company, is required to be disclosed in the corporate governance report of the company, which forms part of the annual report. Now, this skills matrix, which is identified by the company, should also be referred to by the NRC while selecting a person for appointment as a director in the board of the company. Therefore, a reference to the same is very likely to be given in the nomination and remuneration policy of the company. Not only this, the listing regulations also requires the NRC to frame a board diversity policy for the listed entities. Board diversity policy would generally ensure that there is an optimum combination of executive and non-executive directors in the board of the listed entity. There is functional diversity so far as the functions of the directors with respect to the various activities in the listed entity is concerned, as well as stakeholder diversity. Therefore, this board diversity policy is again something which companies, although may adopt separately, can also be formed a part of the nomination and remuneration policy of the company. Next, we move on to the risk management policy of the company. Now again, while the Companies Act does not expressly require a company to have a risk management policy in place, it talks about the risk management plans and processes and requires the companies to disclose the same in the board report of the company. Therefore, it is likely that every company would have a risk management policy in place, whether expressly stated as such or labeled in some other manner. Now, when it comes to the listed companies, top 500 companies are required to have a risk management policy in place. The companies which are also required to constitute a risk management committee. The minimum contents of the risk management policy has been prescribed by the listing regulations, which include a framework for identification of all risks relevant to the listed entity, which may include financial risks, operating risks, sustainability risks, etc. Cybersecurity risk again is a very important risk that a company may face. It also requires disclosure of the processes in place for mitigation of such risks, and very importantly, it requires to have a business continuity plan within the risk management policy of the company. There may be other policies as well, which the regulations may not, the Companies Act may not specifically require. For example, the RPT policy, and I think we discussed about that in our earlier episode as well. Ma'am, do you think that policy is also something which would require amendments, and if so, what sort of amendments?
Right, Payal. So we already dealt with what kinds of contents will an RPT policy have. Whether it is identification of who will be RPs, what will be the RPTs, whether there would be exclusions to RPTs, what would be the approval hierarchy, what would be the disclosure norms, what would be the meaning of material modifications to RPTs. So all of this goes into the RPT policy. Now, when an unlisted company has a voluntary RPT policy in place, it's very unlikely to have all of this in the policy. But once you become a listed company, the amendments will have to be made in line of the requirements under listed regulations. Apart from this, there's also one particular, I would say, a hidden code which is there under Schedule 4 of the Companies Act, which talks on the role of the independent directors. It states that the independent directors are required to ensure that the board complies with the code of conduct framed by the company. Now, many companies, unlisted companies, will also not realize that they need to have such a code in place.
Right.
But even after being an unlisted public company, this preparation of code is anyway required under law. Further, when you become a listed company, the said code of conduct becomes applicable to also the senior management personnel. Basically, the applicability gets broadened. Now, after talking on the existing policies that could require changes as we discussed, let's now come to the new policies under the listing regulations which a listed company would be required to adopt. Starting with the preservation of document policy and the archival policy. Now, under this policy, you need to specifically have to lay down what would be the mode of preservation, what would be the extent of preservation, which all documents would be permanently preserved, which all documents would be preserved for 8 years, documents which there is no specific requirement of preservation. Also, the authority who has to decide on the tenure of preservation, mode of preservation, manner of disposal, etc. Talking on the archival policy, now this policy has a relevance in terms of, let's say, the intimations which go on the website under Regulation 30. After a period of 5 years, they have to be maintained as per the archival policy. So that is the role of the archival policy for documents which have completed their shelf life on the website or on the records and have to be submerged somewhere but not completely disposed of at the same time. After this, I think, Payal, we have to talk on the dividend distribution policy. What do you have to say on that?
Right. So the dividend distribution policy is again something that a listed company is required to formulate. And as the name itself suggests, the dividend distribution policy is supposed to give a guidance to the listed company as well as an information to the shareholders on what are the circumstances in which a company is likely to declare dividend or is not likely to declare dividend. What are the factors that the company will consider before declaring dividend, and how will the retained earnings, if any, be used by the company for its future operations. Talking about Regulation 30 again, since you mentioned about the archival policy in accordance with for the documents disclosed under Regulation 30, a listed company is also required to formulate a policy on the determination of materiality of events and information. Now this policy is again something which we have covered in our previous episodes, so the link will be given in the bio. Next, talking about other policies that a listed company may be required to formulate would be a policy on determination of material subsidiary.
Right.
Now, what is material subsidiary? Something which is defined under the listing regulations itself, and these are subsidiaries that contribute to 10% or more of the consolidated turnover of the listed entity. There are certain obligations with respect to these material subsidiaries, and with respect to a specific obligation of appointment of an independent director of the listed entity on the board of the material subsidiary, the definition of material subsidiary is slightly amended to link it with such subsidiary that contributes to 20% of the consolidated turnover instead of 10%. Right? There are certain other obligations with respect to other unlisted subsidiaries, whether material or non-material, and depending on the companies usually make such obligations also a part of the policy on determination of material subsidiary. I think with this we can complete our first section of discussing about the existing as well as new policies in which changes would be required. Next, let us move on to the corporate governance disclosures. And as discussed, these corporate governance disclosures again can be divided into two parts. One would be the quarterly stock exchange intimations on corporate governance affirmations, and second would be the specific corporate governance report, which forms part of the annual report and is required to be disclosed on an annual basis. So let us first start with the quarterly disclosure requirements under the corporate governance certificate or corporate governance report. So this certificate is signed by the compliance officer or the CEO of the listed company and is required to be intimated to the stock exchanges on a quarterly basis. The quarterly disclosures contain the general disclosures on the composition of board and committees, their meetings. A specific affirmation is required with respect to RPT related compliances, wherein the listed entity affirms that prior approval of audit committee has been taken for all related party transactions. The transactions under omnibus approval has been reviewed by the audit committee periodically, and material RPTs, if any, has been placed and approved by the shareholders. Next, we move on to the half-yearly disclosures. So the quarterly filings of stock exchanges regarding corporate governance, when given on a half-yearly basis, that is for the second and the fourth quarter, it includes certain additional details. The additional details is with respect to the financial assistance, whether in form of, let's say, loans, advances, security or guarantee, including letter of comfort, by the listed entity to any of the following. Who are the following? These are the promoters of the listed entity, the promoter group of the listed entity, directors of the listed entity, KMPs of the listed entity, and those entities that are controlled by either of these four. So a disclosure is required in case any financial assistance is extended to either of these, and an important catch here is that there is an affirmation that states that the financial assistance has been extended in the economic interest of the listed entity. So again, a listed entity will not only be required to track and keep itself well informed of where all these financial assistance have gone, but also ensure that the listed entity has a proper commercial justification with respect to why such financial assistance has been extended to such parties. Next, we move on to the disclosures, the additional disclosures that are required to be given in the second quarter. So the second quarter is generally the quarter in which the annual general meeting and related compliances, for example, let's say the annual secretarial compliance report, etc., are given by the listed entity. Hence, the quarterly corporate governance report for the second quarter also contains relevant affirmations with respect to the AGM related formalities. Last, we move on to the fourth quarter, where again there are certain additional compliances or affirmations which are to be given on an annual basis. There are two additional affirmations. One is with respect to the compliance with all applicable provisions starting from Regulation 16 to Regulation 26A, which are also more commonly known as the corporate governance norms. And second is the affirmation with respect to website disclosures. So again, Regulation 46 of LODR prescribes the various website disclosures, and an affirmation is required to be given for each of the items under Regulation 46, along with the specific web links of such items disclosed on the website of the listed entity. So that's it with the quarterly corporate governance disclosures that are filed with the stock exchange. Next, we can move on to the annual corporate governance report.
So basically, whatever contents go into the quarterly corporate governance report, the annual disclosure, so basically whatever with respect to the composition of the committees, composition of the board, meeting details, details on remunerations, stakeholder communication, shareholder communication, details on the annual general meeting, all of this on an annual basis is required to be given under the corporate governance report, which again forms part of the annual report. This of course also is for top 1000 listed entities. There will also be a non-financial disclosure in the form of BRSR, which goes along with the annual report. Now talking on the specific disclosures under the CG report, which goes annually as a part of annual report, from financial year 23-24, apart from the details of the directors and KMPs, you will also have to give the details of the senior managerial personnel. Not only this, there's one more very important disclosure which forms part of this CG report, that is the details of the loan and advances given to any by the company and its subsidiary to any of the directors or any entities in which the directors are interested. So how do we refer to which all entities are, where my directors are interested? So the regulations itself give you an explanation that entities which are covered under section 184. So we'll take the definition of entities in which directors are interested from section 184, and we are going to state the disclosures of their loans and advances not going only from the listed entity but also from the subsidiary. So directors of the listed entity and entities where the directors of the listed entity are interested, the details of that, plus the loans and advances given by the subsidiary and the entities in which the directors of the subsidiary are interested. All these details are going to be incorporated in the annual corporate governance report. So with this, we complete our policy framework and CG disclosure contents, and let's just quickly recapitulate that in the first episode we discussed on the institutional framework under the listing regulations. The second episode we dealt with the timely flow of information. Third episode was on the RPT framework for listed entities. The fourth episode we dealt with the classification into promoter category and reclassification into public. And of course, the fifth episode, as we concluded today, is on the policy framework and the CG disclosures. We would be glad to receive any feedback on the episodes, and thank you again for listening.